Over the past few days, weeks, months, we've all seen President Trump's negotiating style up close and personal. Now, of course, not everyone is going to agree with it. However, many in the business community give Trump props for being an effective negotiator. Now, as I think about Trump's negotiating style, I'm certainly not going to mimic large parts of it. However, he has mentioned in his book, The Art of the Deal, that part of why he is an effective negotiator, in his opinion, is that he knows the other parties in the negotiation. I want to focus on that today because for business owners looking to sell, it is very important to know who is sitting across the table from you. Obvious, right? But one part of that I think many business owners are overlooking is how the buyer expects to structure the transaction and how much latitude they have in purchase price, payment terms, et cetera, et cetera. So of course you're going to get to know the person, but do you really know the financing source? Do you really know how much latitude they have with that financing source? Many business owners would say, well, yeah, I know my seller is probably going to use an SBA loan, and I'm familiar with SBA loans. Well, my challenge to you is, are you really? Stay tuned today to learn a little bit more about the SBA program, specifically from the seller's perspective. And at the end, tell me if you learned a few new things about the program, or if you were right in the first place and you already knew all there was to know. I would say there are two fundamental features of the SBA loan program that carry over many of the actual terms and whatnot. First, around the spirit of the program. The spirit of the program is that they want folks that have perhaps not ever owned a business to be able to get into an ownership position and hopefully grow that business. They want the result of that hard work and risk that they're taking in buying the business to flow only to that new owner and not to the existing owner. Additionally, a hallmark of the program is that a loan will not be denied due to lack of collateral, which is very helpful in business acquisitions because there's typically a lot of what some people call blue sky, which is an uncollateralized portion of the loan, or some other folks call it an airball. Additionally, there are common features around term, typically 10 years unless there's real estate. Real estate can go up to 25. Interest rate, which would be typically prime plus 2.75% or prime plus 275 basis points. The interest rate is floating, not fixed. Most banks will adjust it quarterly. And finally, the maximum amount of the loan is $5 million. Speaking to one of the concepts about the desire of the SBA for the proceeds to go to the new owner, not the former owner, is that the owner is not allowed to be an employee post-close. The seller and the buyer can sign a consulting agreement for up to a year, but no ability to be an actual employee. Additionally, a feature common in lower middle market deals, which is called an earnout, is also not possible. An earnout is where a portion of the consideration for the business is not paid today. It's earned over some period of time after the close and is paid out based off of whatever metrics the buyer and seller agree to. SBA doesn't like that because they feel like that is diverting more money to the former owner. Even though I don't necessarily agree with that viewpoint, it is what it is. As the seller thinking about the SBA loan, it's important to understand that any buyer is going to have to sign an unlimited personal guarantee. So if that SBA loan is $4 million, that person is on the hook for that $4 million. And I will tell you that defaults on SBA loans are it's a relatively low rate, but it does happen. And there are major teeth associated with that personal guarantee. People lose houses, people lose everything they have because of that personal guarantee. Not trying to scare anyone off or anything along those lines, but that is just to show to the seller that if there's a buyer out there willing to take an SBA loan, they are really putting a lot on the line in order to pursue this. And so As we talk about having skin in the game or having aligned incentives, that personal guarantee, in my opinion, goes a long way towards aligning incentives. The last thing that the buyer wants is for this business to go under, because they are going to have major harm, kill their credit, have bankruptcy, et cetera, et cetera. Now, also as the buyer, the legacy of your company might be tarnished, but I think the buyer is going to be more concerned about all the turmoil that he has to go through should the loan default. But again, default rates are pretty low. The SBA program also requires a 10% down payment from the buyer. That doesn't necessarily have to come from the buyer directly, but he or she has to potentially could raise that money from personal funds, family and friends, et cetera, et cetera. The idea again here is to align incentives. They don't want a situation where somebody has relatively minimal personal assets with no down payment, with minimal personal assets. If something happens, they could just say, here, take the keys, I'm done, with no real harm to them. So again, with the down payment and the personal guarantee, just want to fully show that the borrower has a lot of skin in the game and cannot just cut and run at the first sign of trouble. Now, the reason why there are so many lenders that pursue SBA loans is because of the SBA guarantee on the loan. It's not 100% a loan, typically a 75 to 80% depending on the type of it. Because of this guarantee, there's really almost a cottage industry around it. There are non-bank lenders, there are loan brokers. The long and short of it is that there is a lot of interest in doing these deals. I would say that some of the banks that I work with are very sophisticated, and it really feels like a legitimate underwriting process. Other banks that I've worked with, it just feels like they're trying to dot all the I's and cross all the T's to make sure that the SBA will approve the loan. Up to you as it relates to which type of lender you would prefer to work with, but because of that SBA guarantee in place, it's a lot different dynamic than whenever you're looking at lenders that primarily target companies with, let's call it 25 million in revenues or greater. There have been some recent changes to the SBA loan program. Prior to these changes, the deal had to be a 100% change in control. Now that is not required. There can be a partial change in control. However, if the seller owns 20% of the company post-close, the seller would also have to personally guarantee the loan, which is not too attractive for most sellers, I wouldn't expect. The other new development is that a seller note can be used as part of the down payment, up to half of the 10% requirement. We'll go into a little bit more details about how that is effectuated, a seller note being used for part of the down payment, but that is an interesting feature for SBA loans, and it absolutely plays into the types of structures you might see when somebody makes an offer for your business. Now let's talk about what a common structure might be for a buyer that is making an offer for a business then that buyer is going to pursue SBA financing. First, I would say that there's going to be at least 20% in the form of seller financing. The days of 100% cash, I think, are long gone. Realistically, I would encourage you to expect at least 20%, sometimes up to 50%, depending on the situation. High customer concentration, cyclical industry, those are situations that it would be much higher than 20%, but solid businesses with stable earnings and revenues, non-cyclical, non-project oriented, still think you're gonna see at least a 20% seller note. As it relates to that seller note though, typically you might see two seller notes. I mentioned earlier that a seller note can be used as part of the down payment. Fully expect your buyer to take advantage of this. So I would expect one seller note to be at least 5% of the purchase price, and for that seller note to be on full standby for 2 years, and then fully amortized over the 8 years thereafter. The other seller note, which usually is larger, I would say, because again, if we're having a 20% of the purchase price in the form of seller financing and only 5% is on standby, then you can see that the second note would be much larger. I would say you should expect a term and amortization of somewhere between 5 and 7 years. Sometimes that second seller note will be fully amortizing with payments starting the first month or the first quarter post-close. Sometimes there might be a 1 to 2 year interest-only period where interest is being paid, but only interest, not principal. Definitely more variability, I would say, in terms of that second seller note, but the second seller note is usually going to be larger and it's usually going to be paid off prior to the SBA loan being paid off. Now, I know you might not be thrilled to hear that that second seller note, you might only get interest in the first year, and also probably don't love to hear that that first seller note, you're not getting any payments those first 2 years, but that actually can be helpful to you as it relates to getting your loan approved. Sometimes I've heard business owners say, well, the SBA doesn't really allow how big the loan is, just up the loan so I can get what I want and you'll be fine. Well, generally speaking, I would say, even though you might think your business is worth more, if your buyer is using an SBA loan to buy your business, then I think you need to expect a 3.5x to maybe 4.25, maybe 4.5 if it's a really outstanding business. Even though the loan size could be larger, lenders are going to look very hard at a ratio or a calculation called debt service coverage ratio. That's the debt service, not just on the SBA loan, but any seller notes divided by EBITDA, or essentially operating income. If that metric drops too low, loan's not getting approved. For that reason, the standby feature, as well as a potential interest-only feature on the larger seller note, could actually help get you more money for the business. However, you're gonna have to wait a little bit longer before you start getting that. It's a risk. Some attorneys I've talked to tell me they advise their clients that they should just assume that they're not going to get paid any of the seller financing. I don't think that's true. However, that certainly could happen depending on the situation. But again, it all has to be evaluated in whole to determine whether or not this is going to be an offer that you're willing to accept. And if it's not one that you're willing to accept, I encourage you to think about it through this lens to see if you think a better offer really is realistic. The other potential challenge to getting more money for your business is the valuation. As part of the process, the bank must order their own valuation. It doesn't matter if you have one or if you used one firm, the bank is going to use who they use, and I will tell you, it becomes an issue on many deals that we've worked on. Ultimately, it's never been the factor that prevented a deal from getting closed, but literally on every single deal, it was a challenge that we had to work through in order to get the valuation high enough in order for the bank to approve the loan. It's frustrating. But again, I mean, here's a third party saying this is what the business is worth. If your buyer is trying to pay more than that, there's an argument to be made that they're overpaying for the business. Now, sometimes valuations come back much lower than I think they should. Sometimes they come back higher than I think they should. But as it relates to your ability to negotiate a higher purchase price, maybe you can. But if in the valuation process, it comes back that the price the buyer is willing to pay is too high, your negotiating skill ultimately didn't do any good for you because the loan's not going to get approved. So we mentioned that the banks will use a valuation as part of the loan approval process, but what else is involved in the loan's underwriting process? I'm sure you can imagine that the main ones, background check, looking at the financials, et cetera, et cetera. As it relates to the financials though, what are they going to look at? Well, unfortunately, they're going to look at the tax returns. Pardon me for being a bit informal here, but that really sucks, both for the buyer and the seller. I don't know how you run your business, but in all of our businesses, we try and get taxable income as low as possible. We want to be able to report high income, and we want higher income so that our companies are profitable and whatnot. But as it relates to the actual tax return, we want that number as low as possible. That's the number that the bank is going to use, and it really can harm the situation. The bank will allow add backs. So, if your net income is, or your taxable income is 100,000, the bank will say that, okay, are there any personal expenses, or what is the compensation that you've paid yourself? Those are definitely areas that you can add back. So maybe your personal comp was 200. So 200 plus the taxable income, now it's 300. Maybe that's the number that works for the valuation of your company. Some owners, though, it's a little bit tricky because they'll tell me that they put all sorts of personal expenses through the business, which is fine. We don't really care. SBA for this purposes is not going to really care. They're not trying to audit your tax returns, but some owners do get uneasy because they don't want to talk about how all these expenses were personal, that they used as deductions. So that's just a balance that you're going to have to take as it relates to what information you want to, not necessarily what information you want to share, but how aggressive you want to be with your buyer in terms of making add backs in order to get that EBITDA or seller discretionary earnings figure as high as possible. And we're not just talking about last year, unfortunately. We're talking about the last 3 years. Now, banks will look at the prior periods a little bit differently than the current period, but I mean, current period is definitely the most important. You really can't completely ignore the prior 2 periods because sometimes the prior 2 periods are a big holdup and actually prevent the deal from actually getting closed, or at least prevent the deal from getting SBA financing. As it relates to the prior 2 years, we're gonna again talk about this metric, debt service coverage ratio. Debt service coverage ratio that lenders like to see is at least 1.2x. Some have what we could call a whisper number of 1.3 or 1.4. However, personally, I would say that I'm not going to do too many deals unless it's at least a 1.5x debt service coverage ratio. My figure for EBITDA might be a little bit different from the banks. So for that reason, their 1.2 might be roughly equal to my 1.5. But again, based off my calculations and whatnot, I'm looking for at least a 1.5x debt service coverage ratio. 1.2 is not enough cushion for me personally. Again, this goes back to how much your buyer can pay, not only can pay, but I guess how much debt they would be able to get for your business. So I would like to dive into some real examples to talk about how debt service coverage ratio is actually calculated and my take on what would happen if debt service coverage ratio in prior years is not adequate to get the loan approved, at least from being less than 1.2x.
Here's a simple model I put together to show how SBA structure might look in a real deal. Here we have the purchase price section. The EBITDA for this deal is 1.759 million. The EBITDA multiple is 4.12, with the total purchase price being 7.25 million. A few purchase price assumptions: the buyer down payment is 5%. The deferred seller note, meaning it's going to be on full standby for 2 years, is 5%. A plug for this non-deferred seller note of 1.45 million, and then a contingent seller note of 750,000. Haven't talked about a contingent seller note, but essentially what this is a note that is on the books at close. However, if certain metrics aren't achieved, then post-close that note can be forgiven or written off. Below it is what's called a sources and uses statement. Sources and uses are the sources of capital, where the cash is coming from. Uses is where the money is going. We can start with the sources side. We have a revolver, which we're not talking about a revolver on this deal. Total leverage of 7.6 million. That ties to this debt assumptions section down here. You can say we have a full $5 million SBA full $5 million 7A facility. The non-deferred seller note of 1.45, deferred seller note of 400,000, which is 5%, and then the contingent seller note of 750,000. Therefore, total leverage of 7.6 million, which ties to this. The sponsor or the buyer is bringing 400,000 in new cash equity to the deal, which again is 5%, for total sources of capital of 8 million. In the uses side, we can see that the cash plus seller financing is $7.25 million, which ties to the purchase price. Additionally, we have $400,000 in cash going to the balance sheet, $200,000 in fees and expenses, and then $150,000 for the SBA guarantee fee, which is 3% of the loan value. In this model, I have a tab for debt service coverage ratio. I've broken it down a little bit differently, so want to do that here. Here we have an abbreviated income statement. We have revenue over the historical and forecast periods, cost of goods sold, gross profit, SG&A, and ultimately EBITDA. What you'll see here is very meaningful growth from 2021 to 2024. Now, many lenders might not go so far back as 2021, but certainly 2022 through 2024 will be looked at. First, we have the SBA debt service. This is on the 7A. You can see that for 2022, the debt service coverage ratio is too low. However, in future periods, it's high enough. Now we're going to factor in the non-deferred debt service. This would be the $1.45 million seller note. The debt service on that you can see is $336,000. Therefore, the debt service coverage ratio for the SBA debt as well as the non-deferred debt service is 0.58. However, in 2023 and 2024, that number grows to 1.56. We do have a section for the deferred and contingent debt service, but that is not expected to be paid for the first 2 years, so that doesn't have any impact. So what does all this mean? My personal opinion is that on this particular deal, the debt service coverage ratio in 2022 is not going to hold up the deal. This 1.5x is a good number. I think anything above 1.5 really is a strong metric for the bank. And that because of that, they will overlook what happened in 2022, especially if there's some story that you as the seller can share as to why that was a year that shouldn't be or should be discounted, I guess I should say. The only other component to think about, though, is valuation. I think that your valuation on almost 1.8 million of EBITDA should be fine. But again, that's outside of your control, outside of the buyer's control. Just another factor to keep in mind as you think about how realistic the offer is and also the likelihood that your buyer or really any buyer offering this deal and structure can get the loan approved.
So spent a lot of time on educating you, gave you a little bit of my perspective on how I like to see deals structured or my own personal comfort level as it relates to how I would structure a deal. I'd like to give you 4 specific pieces of advice, though, as it relates to setting yourself up for success if your buyer is pursuing an SBA loan as the majority of the funding for the purchase. First off, this is universal advice. Every business owner should take this to heart because it is the #1 thing that kills deals, and that is a performance drop-off during the diligence period. I can't think of a single thing worse than performance dropping off during the diligence period. I try not to exaggerate or hyperbolize certain things, but this is one that I seriously don't think you can overstate how critical it is for performance to be maintained during that diligence period. The second piece of advice is to remember that most loan officers are essentially business development folks. Not to say that that has any impact on the quality of that person as a person, whether they're smart or successful or this or that, but just I encourage you to think about that because as a business development person, they're not the underwriter. They're not the ones that are going to have to go to the investment committee and really be on the hook. I mean, again, typically for many banks, that's going to be the underwriting committee. When you're going through this process, what I would encourage you is to work with your buyer to make their life as easy as possible. I guarantee you that your buyer is getting very frustrated with their lender at some point throughout this process. They are going through a lot, but because of that, try and make it as easy as you can on them, not just because you feel bad for them, but in the spirit of trying to get the deal closed. I would assume that they are very committed to getting this deal closed. Just work with them, because getting a deal closed, I would imagine, is in everyone's best interest. Now, if they're asking, if the lender's asking the same question 5 different times, and the buyer has to provide a different schedule each time, do you think this process is going to be fast? No, it is not going to be fast. Finally, a little bit more tactical of a suggestion is to ask for a personal guarantee on the seller notes. The seller notes are going to be subordinated to the senior note, just how it's going to be. But that doesn't mean you shouldn't ask for a personal guarantee. Most likely, your buyer is not going to be able to satisfy that full personal guarantee, but it doesn't hurt to have that. I think it's always better to have that than not. So if you're going to have a meaningful portion of the purchase price in the form of seller financing, at the very least, I think you should ask the seller to personally guarantee that as well. So as I mentioned at the beginning, an important aspect of being an effective negotiator is understanding the other parties at the table. Now, at the beginning, I might have mentioned that might have implied that it's just the seller and the buyer sitting at that table. But based off the structure of the SBA loan program, I would probably encourage you to think of the lender as being another party in that negotiation. I think business owners typically are pretty good at negotiating, but here it is an example due to the structure of the SBA loan program, due to the underwriting requirements, specifically the valuation, that sometimes business owners are such effective negotiators, they've negotiated a price that somebody is willing to pay, but that ultimately can't get done due to the confines of the SBA program. I guess my only advice there is to keep growing your business so that you get to the size where your buyers are not using SBA loans. But unfortunately, then you're going to have a whole host of other potential problems that you have to address, or at least idiosyncrasies or nuances that are not present whenever you're dealing with a buyer that's pursuing an SBA loan. I mentioned at the beginning as well that this might be new information for some, might not be new information, but I am curious as it relates to the topic of the SBA loan program. Do you feel like you're better educated to have a more balanced discussion with your buyer as it relates to the various features of the SBA loan program? I hope your answer is yes, because I don't feel like a lot of this knowledge is very common, but you know what, maybe it is, and the joke's on me. Let me know in the comments. Thanks for watching.